Thank you all for your time today. I am the Finance Director for Calima Energy. And I've been involved with Calima since 2015, and I have to say that right now we're in the strongest position we've ever been in. We've built a strong position in Canada. We have three main assets. The Montney, which is our rich wet gas up in northern BC, and the Brooks and Thorsby, which are conventional low decline assets which have very strong economics in Alberta. We chose Canada for three main reasons. Number one, it's a tier one jurisdiction. Number two, they've been producing oil and gas for over 100 years. And number three, we found they are the best people to work with. This provides us with a phenomenal energy asset base that can generate tremendous free cash flow, and we can ramp up as energy prices increase. The assets that we have at Brooks and Thorsby are tier one. They have all-in costs of $26 per barrel, so that's including costs of drilling and completion, and their operating costs are very low, $10 to $12 per barrel, which makes them very strong with oil prices at $68, $69 a barrel. At $69 a barrel, the business makes tremendous amounts of money, and I'm a big believer that the oil price will continue to grow. We feel that, along with our other analysts, that we can see $100 oil, and at that price, we're expecting our multiple of our company to grow somewhere between 5 to 10 times our current valuations. Most interestingly for us, we have a significant upside in the Montney. Whilst Calima did enter the Montney early, we are the last independent holding with over 60,000 acres in northern BC. Our acreage can be converted to the main grid through a 100% owned Tommy Lakes facility we have to the north, with a very small 12-kilometre pipeline, giving Calima shareholders significant upside to the Western gas market. We trade on the ASX under CE1. Current market cap is around $100 million with 500 million shares on issue. Analysts have us between 50 cents and $1.50 per share. Current share price is around 18.5 cents. A good reflection of our business is the $25 million facility that we have with National Bank of Canada. That provides us a very low cost of capital at 4%, and it also gives us significant ramp-up capability. So we can draw on this facility and pay it back as and when we need it. We are a development company with 3P reserves of 25.7 million barrels of oil, and in a short 4 months since we acquired Blackspur, our production has grown from 2,500 barrels a day to 3,300 barrels a day. With gross revenues last month of $4.5 million, we had net revenue of $2.5 million. So our ability to grow is substantial, and we believe within the next 12 months we'll be able to pay dividends and do a cash buyback. We're now drilling 3 wells at Thorsby, which will grow our December production exit to around 4,500 barrels of oil per day. Our current objective by the end of next year is to get to 5,500 barrels of oil per day, but realistically we believe we can get there within the next 8 months. What makes Calima's story so believable is that not only do we say we can respond quickly to take advantage of the oil market, but we do just that. We've drilled 6 wells in the last 2 months, and we've got 1 to go. And our wells can be put on production within 30 to 60 days. In addition, we're continuing to look for offsetting acquisitions to grow our production base. And once again, I mentioned we've got the ability to unlock the Montney value. Our growth phases are focused on increasing production ultimately to 10,000 barrels of oil per day. We have over 140 locations at Brooks and over 100 locations at Thorsby. As you can see from the resource breakdown, it's essentially, we've only got 37 locations booked in a PUD, as PUDs at Brooks, and 27 in our PUD resource model. Our EV to 2P valuation is trading at around 4.4 times, which is a significant discount to our peers both in Canada and on the ASX. Also note that we're an oil-rich story with an average of 70% oil. As you all know, the conversion from gas to oil is 6-to-1. So when you're looking at our peers, they have the market significantly overvalues their 2P valuation. In the US or in North America right now, the difference between oil and gas is about 16-to-1, as opposed to the 6-to-1 conversion. So if you're investing in oil and gas companies, you want to invest in an oil story. And as our analysts have pointed out, we've got valuations between 50 to $1.20 per share. So this slide says it all from us. Calima is highly torqued to the oil price. We've done our sensitivities at 3,300 BOE in the grey and 5,500 BOE in the green. First slot on the bar graph is $60 per barrel, second one is 70, and the third one is 80. And as you can see, at 5,500 barrels of oil per day, we're going to be generating somewhere between 53 to 83 million EBITDA. This business has the benefit of having all of its capital costs mostly paid for, so we have plenty of capacity, up to 10,000 barrels of oil per day. And when we drill, we get payback very quickly. So the average well recovery is between 4 to 6 months on your drilling costs, drilling and completion. A critical part of our strategy is to unlock the Montney. We have a 2C resource of 192 million barrels of oil and a 3C resource of 300 million barrels of oil. Tourmaline over the last year, together with CNRL and ConocoPhillips, have sucked up all the other players in the region. And in conjunction with the ARC and 7Gen mergers, that's $10 billion worth of acquisitions in the last 12 months. And we're the last acreage owner in the region. We have our facilities and our resources ready to be unlocked. Finally, we have the people on the ground. Black Spur has a substantial team in Canada. They've been working together for 10 years. They're a credit to the oil industry, and I'm actually really proud to be working with them. So I'd like to thank you for your time, and also to introduce Jordan Kevol. He's our Managing Director, and on the weekend he took some video for us out on site at Thorsby.
Hi everybody, my name is Jordan Kevol. I'm the Managing Director of Calima Energy Limited. I'm here to present to you today about Calima and our operations, particularly in the Thorsby field, where I am on site today on the location of our main oil battery in the Thorsby field, as well as an active drilling site. We're currently drilling a well as part of our Leo program, a 3-well Thorsby drilling program targeting the Sparky Formation. And we're currently drilling in the horizontal section of well number 2 of our 3-well program. I'm going to take you on a bit of a tour of the rig and the site today, as well as update you on the current operations of the company and where we are headed over the next little while. Calima Energy has 3 distinct operating areas. First, in northeast British Columbia, there's the Montney area, which is a liquids-rich, gas-prone area that Calima has 60,000 net acres of land in. Secondly, where we are today is the Thorsby area of central Alberta, where we drill the Sparky Formation, and this drilling rig you see behind me is currently drilling a horizontal well into the Sparky Formation. And our third core area is known as Brooks, where we target the Sunburst Formation and drill primarily open hole, unstimulated, conventional wells. So this particular site we are on is the location of our 16-5 oil battery, and this is the main oil processing facility for our Thorsby field. As you can see, the pump jacks behind me here, these are previous wells that we have drilled into the Thorsby field, all targeting the Sparky Formation. Wherever possible, we like to drill multi-well pad locations. What that means is as many wells coming off of the same site as possible, all drilling horizontally in different directions into the field. And that really helps us minimize our tie-in costs for the wells. There's very little pipelining required when all of our existing processing equipment is already on site. We do pad drilling wherever possible in each of our fields, both in the Thorsby area as well as the Brooks area. We're currently in the process of drilling an incremental 3 wells off of this 16-5 pad. And then there will be a total of 6 wells producing into our oil processing facilities, all of which had very minimal costs associated with tying in. We're currently drilling in the horizontal section of Leo number 2, and we're currently experiencing excellent oil and gas shows as we drill through this Sparky rock. Sparky cuttings right there. It's a medium grade sandstone with looks like pretty good oil shows in it thus far. Sparky wells that we're drilling right now have very robust economics at $70 WTI oil prices. The cost to drill one of these wells and complete, equip, and tie them in is approximately $2.5 to $3 million, depending on the length of the well and the number of fracs that we put into the well upon completion. At $2.5 million capital cost, these wells generate a $7 million NPV10 value, have less than a 6-month payout, and generate a approximately 500% rate of return. Here at our 16-5 oil processing facility, we're currently processing 850 BOEs per day of oil and gas. This Leo 3-well drilling program is all going to be processed at this oil battery, and we have significant capacity for growth beyond that. We can process approximately 3,000 BOEs per day of oil and gas at this site, and we also have on-site water disposal for this facility as well. Calima is currently producing about 3,500 barrels of oil equivalent per day, about 800 of which is coming from this Thorsby field that I'm standing in right now, as well as we have approximately 2,700 BOEs per day of production coming out of our Brooks field. Our current guidance states that we will be exiting the year of 2021 at 4,500 BOEs per day of production by the end of this year. That incremental production from the 3,500 to the exit of 4,500 is going to come primarily from the drilling of these 3 wells on the Sparky Formation in the Leo drilling program that is currently active on this site as we speak. In addition to this Thorsby field, Calima also has significant operations in the Brooks area of southern Alberta. In the Brooks area, we primarily target a formation called the Sandhurst Formation. We drill horizontal wells into this conventional style long. We're able to drill those wells, complete them, bring them on production for an all-in cost of $1 million per well. At $70 oil, those wells yield a 500% rate of return and a less than a 6-month payout per well. Calima just completed a 4-well program in the Brooks area, the Gemini program. We drilled the Gemini 1 through 4 wells. Those wells have recently just completed their 30-day IP periods as per a recent press release from Calima. Corporately, Blacksburg has $10 to $12 operating and transportation costs, or lifting costs, and that contributes to our very low break-even cost of $26 per barrel WTI. What that means is if oil price drops, we can continue to produce our wells in a positive profit margin all the way down to $26 WTI, which is a very low break-even cost for an oil-weighted production producer.
Great, thanks everyone for your time. It was a bit long, but you get the message.